Hey everyone, just a quick note. Sorry for the screen freezes during this episode. I thought I'd fixed it, but it appears I haven't. I don't have time to redo it today. It's still, you can still hear everything, and it's I think the message still gets across. However, next week I'm going to upgrade again and just use a different computer, and hopefully it never happens again. Okay, cheers. Hey everyone, welcome to Breakout Wednesday. It is October 16, 2019. It's currently 2 p.m. in Perth, 5 p.m. in Sydney, and about 2 a.m. in New York on the Wednesday morning. The markets over the last week have been better. We've moved from the bottom of the range to the top of the range. Certainly signs of life. Obviously, it's still a range-bound market. Need to, have a breakout of this high and then a consolidation before my confidence levels will go up. Now, there's a new earnings season in America that's just kicked off, and JP Morgan, obviously one of the major banks, started it off on the morning of the 15th before market opened, and had a good report, gapped up, big volume. And so it's pulled the market with it. There's a few other things that happened that were good yesterday. However, it's a good sign. Hopefully some of the other big banks will have good reports too, and hopefully it will kickstart a bit of a bull run. But it's definitely a good sign. I like to see the big banks have good reports. Moving back to Aussie for a second, some of the ETFs that I like and have talked about numerous times are starting to, show some life, okay? And tech is one of the ones I really like. And remember, my strategy with these ETFs is I only buy them on significant market corrections, okay? So ideally of 20%, but I also get some at about a 10% market correction. And it's different to the short-term trading because I like having a long-term investing strategy as well, where I can buy on weakness and feel like I'm buying when everyone else is selling, and it's worked out well for me. I collect the dividends, and I think those people out there that argue that ETF investing, you're just going to track the market, it's complete BS, right? Because I'm not just blindly buying. If you're blindly buying at any point in time, then I guess you would just track the market. However, it's, when you time it during market corrections and have rules for timing it, it really does work out a hell of a lot better than just blindly buying it. You just need to have pretty concrete objective rules such as the 10%, 15%, 20%, find support levels, 200-day moving average, whatever it is. The whole thing is that you just need to be consistent and you need to do it, and if you're just consistent and do it, I think these ETFs are a very safe way to play the market and invest in the long term. Okay, now moving on. I am now long Apple, and my three favorite stocks in America, Nike, Lulu, and Apple, all at all-time highs. Sorry, and so I'm pretty happy with all these stocks. I'm going to stay long those three, and so I'll touch base periodically to see how those three are traveling. Now, I have a friend, believe it or not, who watches this weekly broadcast, and he asked me, he's an investor, or he was a trader or investor, I think, in ResMed, and he asked me, because he knows that I'm a long-term holder of ResMed, okay? I'm not trading this stock, I'm just holding it. I just really like the company, and I've held it for a long time, and so I've obviously done well. It's just been trending up. But back here, he asked me what happened. What did you do when it had an earnings announcement back here on the 23rd of Jan this year? Did you buy? Did you sell it? And I didn't. I just held it, and obviously it wasn't good. This thing fell 22%. However, the way I view that is that if you're a long-term investor in anything, you're going to have 22% corrections at least once a year, most years at least. And if you're a long-term investor, if you don't have the stomach for that, then you don't do it, And so I expect a fall of 22, figured out, about 20 to 26% in stocks. And so for people who have owned Apple for 10 years or whatever, they've had so many corrections. This correction here from October to the low on 3rd of Jan, I believe this is about 26% as well. And say, okay, and so, so I just told my friend, look, no, I didn't sell ResMed. I'm a long-term investor. When I would sell something like ResMed, which I'm just holding in the bottom drawer in a long-term family trust accounts type sort of setup, is sometimes I play around. I put a 200-day and a 400-day moving average on the chart, and I'll wait. I expect these things every now and then, these long-term investments, to pierce that 200-day line, but it's the 400-day line, they usually don't. Okay, and it's amazing. Like, if you spend some time, just get a 400-day moving average out, and stocks in vicious downtrends that are just complete dogs of a stock, they live below their 400-day line. But these ResMeds and Apples and CSLs and stuff, they like to stay above that 400-day moving average line. It's an objective way that I use. It's completely arbitrary. I just made it up myself over the years, but I certainly like it. If you just look at CSL, anyway. Okay, so I'll move on from there, but hopefully that helps my friend. Okay, now moving on to some stocks in Aussie, and then moving on to American stuff. I finally was stopped out of EOS this week. You can see this descending triangle drawn. I was stopped out and it broke down below this line on the 15th of October. So good trade, happy with that. And obviously there was not just me selling on that breakdown. And, I guess it's not, I'm not the only one that can see technical levels. But this is just a perfect technical trade. Breakout, trend up, break down, get out, okay? Now, the other things another stock I talked about last week, CSL, that was setting up in this base, I'm now long. It had a breakout and it's had a bit of a follow through today. So I'm happy with that trade, and I will be sitting in that one for quite a long time, hopefully. Okay, the next one I discussed last week, CM8. I am long. I bought the breakout. Now, I've talked a few times about first of all, let's just get that, off. Just going to change for anyone that's new. If you want to just change your moving average setups, you just need to go to that settings thing. I'll do it more slowly. You go to settings here, indicators, simple moving average, and you just change it. So I'm just going to get back to my standard ones. Okay. All right. I may have stuffed the colors up, but it doesn't matter. All right. Okay. So moving on, I am long CM8. So I like the base, I like the breakout, and I'll see how that one plays out. We had a really good breakout, and it's just a bit of a pullback on small volume. So anyway, not too worried yet, but we'll see. IFN. Oh, okay. I didn't realize this one broke out today. I've talked about this stock numerous times over the last 2 or 3 weeks. I presume I was filled. I don't know yet, but I mean, I can't see why I wouldn't have been. So anyway, nice setup. I really, really like this setup. We'll see what happens. And anyway, let's just have a look at the volume. Decent volume on breakout. So I'll follow up that one next week. I think there's probably a few Pro Trader members that hopped on board that one today. So good luck. The next one I talked about last week, KZR. It's broken down, so no harm done. This is why I do not, preempt breakout. So I'll keep an eye on that one and see if it sets up again. And I think the only other thing I've entered this week is Cochlear. I like this company. I know a bit about it, and I kind of wish that this is one that I bought, a long, long time ago and kept in the bottom drawer like ResMed. Broken out of this resistance line. And it's had similar resistance points like this over the years, and it's had pretty good runs afterwards. So I thought it was worth a bet, and I'm long Cochlear. Okay, moving on to some setups that have not broken out, I don't think anyway. SEI, okay, base in, it looks like it's about to break out, but it's a decent base. I mean, this thing's like a 5 cent, high risk stock. So for those punters out there, I'm watching that one. Main Pharma, I talked about a few weeks ago, had this massive gap up on a really good report that came out. I'm watching this base. This is in a Davis box currently. I haven't made a decision on it yet, but I'm just watching it chop away in that box. I'm kind of looking at the volume, trying to see if we can get some really, really low volume days, and I quite like it. A few of the bigger stocks at the bigger end of town. Okay, Woolies did break out today. I like the base in Woolies. I like the breakout today. It's pretty textbook. So we had this double bottom here, and we've just sprung off the double bottom and broken out into what I believe is most likely all-time highs. Yeah, I mean, it's not all-time highs, but it's pretty close to it. So some of the stocks at the big end of town, along the same lines, we have Wesfarmers also broke out today. Nice base, kind of textbook as well. So Woolworths, Wesfarmers, pretty cool. A little, back to just the cheap end of town, ATL. This is a pretty tidy little base. So I know I always talk about the 200-day moving average, and obviously, it is a general rule. However, I've stated before, it's I do break that rule when I get a nice base and a nice setup. Some of the biggest moves obviously start when a stock is well below its 200-day moving average. The point for me with the 200-day moving average line is that win-in stocks, really, really good companies with growing earnings, and companies that actually make money. Believe it or not. And they just have huge earnings growth. I mean, those stocks just live above their 200-day moving averages lines, 95% of their time. It's usually the stocks that hang out below their 200-day moving average are just useless companies. Most of them are losing money and have no right to be a stock-listed entity. So that's my general view on 200-day moving averages. But that doesn't mean I'm not going to trade a really good setup that is below it. I'm just going to be so selective. Let's just get rid of all the averages. I like this one because we had this first initial base, and then we have a tightening base on top of this first initial base. So it's kind of like a base on a base, or a cup and a handle, whatever the hell you want to call it. And I like that sort of setup. And so this is also pretty tight. If you look at the handle or whatever here, it's a really, really tight handle, tight base, and it's got gaps above it. And if you think about the gaps above it, it has gaps above it because it's a crap company, right? And it's gapped down, and it's had bad things happen to it. So the fact that it has gaps above it just to me means that this thing's high risk, and it's such a crappy company that it gapped down so many times. However, some people out there like these gaps and they say they get filled, and I don't really have an opinion on that. However, I just like this base, and I like the tightening here. Okay, I know Frank really likes gaps, and so therefore, they must be good. For me, I've just never looked at them, and that's just me. Okay, now there's a few other ones setting up. So there's a little one which I left alone just because I was filled in some other stuff today. RMC broke out today, pretty illiquid, but nice tight pattern. I'm watching KCN. Okay, base in, and if that can just tighten for a bit longer, it could be cool. Okay, so a quick scan. I'm pretty busy with some US stocks at the moment, which are moving. The way I find most of these quick moving US stocks is I just do a Dava scan, any box, 21 days. You can see the settings there, and I just do a scan. Goes super quick. And I accidentally did that on ASX data. So let's just quickly move back to NASDAQ. Scan, okay. It's obviously taking a bit longer because there are just so many stocks in America. However, the stocks I need to talk about are all at the front of the alphabet, so let's just cancel that. AKAM is a stock I've talked about a few times. It has just been based in for a while now. It's in its third box, and I'm just watching this thing tighten, and I'm most likely going to try a trade on this. I'm going to trade it the traditional Davis way, put a stop loss below the box, and play the breakout. So this thing's just been grinding sideways with the market. It hasn't been too badly affected by really big down days on the NASDAQ, and I just have a feeling this thing has a bit of life in it. I'm obviously going to check out its earnings date and make sure I'm not gambling right before an earnings release or anything like that, okay? And there are a few others in here. This is a $10 stock, AMKR, AMKR Technologies. It's got blue sky above it. It's sitting in a really tight Davis box. And I just find some of these really, really quick moving NASDAQ stocks, they're not. This thing's probably not going to base for 4 weeks like I like them to. Sometimes the really quick moving ones, they base for a week or two in a really tight Davis box, and then they just go for it. It's a lot more high risk, but I do a lot of this stuff in my short-term trading account, and I'll follow up. I'm going to have a go at this one if it breaks out, so I'll follow up on that next week. That Davis scan I just did, I can go through there. There's so many trades setting up. It's not funny. The problem is trying to figure out which couple to have a go at. I don't know why I selected that one just then. Let's just go back. And the trick is finding which ones to have a crack at and which ones not to, and you just get better at that with time, obviously. Okay, that's it. Catch you next week. Bye. Hey everyone, just a quick note. Sorry for the screen freezes during this episode. I thought I'd fixed it, but it appears I haven't. I don't have time to redo it today. It's still, you can still hear everything, and it's I think the message still gets across. However, next week I'm going to upgrade again and just use a different computer, and hopefully it never happens again. Okay, cheers.